Okay, hi everyone, this is Gary Wilson. Welcome to this week's live um, Path to Profit webinar. Welcome aboard to all of you, whether you're new students or veteran students, and no matter where you're from, we've actually got everybody. We got people on here literally again from coast to coast in Canada and US also. So welcome aboard everybody. For the new folks, you'll notice that by default you're in mute mode, and of course that's by design because with a lot of people we couldn't all be verbal at the same time. So, but from time to time we will unmute you and bring you up online, okay? And sometimes we do that. I think we did it for Cedric one time and back a few months ago. So you normally use the question box to type in your questions. A few more things. Most of you are live. Some of you are going to be listening to this in recording mode. But for everybody, always remember to look for the email that comes out the next day from Beverly, and it contains the recording of the webinar and also any updates to the systems, the three different platforms, or updates to content. And we usually do that, probably an average of once a month or something going on. So definitely keep an eye for that. She also gives you the schedule of the upcoming webinars. So always look for that. When you're ready for a strategy call, you have to use that time trade link. And that's something that's provided to you in the very beginning when you first get your first set of information. So in any case, look for that. And when you're ready for that, obviously use that link, set one up, and let's get you guys up and running. So in any case, without further ado, here's what we're going to do tonight. First thing is, let me check the question box and clear those out. Make sure we're all caught up for any outstanding questions that people may have. So let me just take a second to go through this. Everybody's just saying hello, and let's see. Tom, okay, yes. Tom and Frank from New Jersey, great call this week, Gary. Tom, that was a good call. Yeah, I appreciate it. Let's see. Bradley Wood. Oh, you got all five there. That's awesome. Thanks, guys. Okay, let's see. Hey, Bill. See your screen showing income expense data. Yes, I'm showing income expense data. I'm just going to do a real brief example of how you calculate cap rate. Excuse me, cash on cash return. They're going to use Ryan Alley's example and go into some more advanced stuff, okay? Stacy says the whole Philly crew is there. That's awesome. That's awesome, guys. I had an awesome time in Philadelphia. By the way, there's a famous street here in San Francisco. You've all seen it. It's the one where the street winds down the hill, Lombard Street. The guy that named it actually named it after a street in Philadelphia. I didn't know that. How about that, huh? By the way, I had an awesome time when I was out there. Went out with my niece Chelsea, and when I was in Philly, and had a probably stayed out a little bit too late, but she's a lot younger than me, so I didn't want to hold her up at all. So in any case, looks like we're all caught up on questions. So first things first, guys. I know some of this, for some of you, you've seen this before, but this is really for the newer folks because the subject has been brought up a lot lately, which is what exactly is cap rate and what exactly is cash on cash return. So let's do that first, and then we're going to use Ryan's example property to go into some more advanced calculations. And it's the kind of thing that if tonight you feel like, wow, this is a little bit beyond me right now, don't sweat it. Just you get you get the Excel spreadsheet for the next calculator we're going to use. You also get the link for the third one we use later tonight, so you can practice on them. There's no harm in practicing that doesn't, use some examples that you have from the real world, plug them in, do them a number of different ways, and that's how you learn. You learn by getting in the game, swinging the bat. We give you the tools and give you the guidance, and but you gotta meet us halfway. So in any case, don't worry if you feel like you're struggling. You're going to be fine. Everybody is. I mean, believe me, thousands and millions have walked in your shoes before, and everybody can do it. None of the math is beyond multiplying and dividing, by the way. Okay, there's no algebra, there's no calculus, there's nothing like that. When we get to those forms, that stuff is all done for you, and I'll show you that later. So first, do the example first. Okay, up here we describe the income for this example property. Total income is $13,800 per year. Okay, that's the main thing you got to remember from this income section. Expenses are all the known expenses or somewhat fixed expenses for the year. They're not really fixed, but you can count on these no matter what. Taxes, insurance, the municipal charges. When we say water, sometimes that includes water, sewage, and garbage, okay? And basic maintenance and repairs. This is not capital improvements. This is just, painting, cleaning, things like that. It's nothing to do with putting on new roofs. Those are called capital improvements, okay? In any case, what we do is we first off take the annual income, subtract it by the annual expenses. So these all have to be added up, okay, to get the annual figures. And the resulting income for the year, excuse me, what we call a net operating income. So write that down, NOI. And this is all in the material too. So when you go over the material, this will be a refresher for that, okay? So we've got what's called our NOI. That's net operating income, which is your gross receipts minus your basic expenses, not minus your mortgage payment. If you have a mortgage on the property, this does not include that yet. That comes later, okay? So we have NOI. Now let's assume a purchase price of $70,000, down payment of $14,000, okay? That leaves a loan of $56,000, right? $70,000 minus $14,000 leaves a balance of $56,000. We're going to assume we have a 20-year term, a 20-year mortgage with a 20-year term at 5% interest, okay? That resulting monthly payment is $369. Now that's just principal and interest. This is not PITI, this is just PI. It does not include taxes and insurance because we already accounted for that up here, okay? So that the taxes and insurance are an expense, okay? In any case, so we've got our net operating income. We know what our monthly mortgage payment is. We know that our cash return, right, if we subtract, or we take our gross receipts, our monthly rents, subtract the monthly expenses, subtract our monthly mortgage payment, we have a monthly cash return of $529.88. That's what's left in our pocket after paying everything, including the mortgage. If we multiply that times 12, that gives us a resulting annual cash income of $63.58.56. Okay. Now let's do the calculations. That's just the basic stuff. That's just basic income and expense. Okay. Let's do cap rate first. Cap rate is this figure here, your net operating income, the $10,793.54, okay, divided by the purchase price of the property. So that gives you cap rate. 10,793 divided by 70,000 gives you a cap rate of 15.4%, okay? That's cap rate. Now here's where the big difference comes in when you're calculating cash on cash return. If you notice when we calculated the cap rate, we took the net operating income and we did not account for mortgage payments yet, okay? So that's one big difference. The other thing is we're dividing that by the total purchase price of the property, all right? Now when we look at cash on cash return, we're actually looking at the cash in our pocket return, the actual cash return on an annual basis, which is our net operating income minus our debt service for the year. So now we have this resulting figure is gross receipts minus all expenses, taxes, insurance, water, sewage, maintenance, and also subtracting your principal and interest of your mortgage payment, okay? Now to get cash on cash return, we take that figure and divide it by the down payment. Now this is just basic stuff. In the real world, if you had a major capital improvement, let's say you bought a property, put down 14 grand, and you put a new roof on for 5 grand. Well, now that number, this number would really be, I mean, you would take your down payment, but also add in, if you laid out cash for that roof installment, you would add that to this. So this would be 19,000. But I don't want to get too advanced here at the moment. I just want to keep it simple. All right, we're going to take cash in our pocket divided by cash out of pocket. We're getting $63.58 per year cash in our pocket after everything, including mortgage. We're divided by the down payment, which is $14,000. That resulting ratio is 45%. That's our cash on cash return. Now what's interesting is this is like blowing some of you away. Is this an actual real cash on cash return? Yeah, it was several years ago. You'd be hard pressed to find that today, but everything's relative. I mean, I could go to markets like Flint, Michigan, Dayton, Ohio, other areas, in and around Pennsylvania, Georgia, Ohio, Indiana, Illinois, there's several states where everything's relative. What I'm getting at is, yeah, this was a real figure. So now let me take a quick breath here and check for questions, because I just gave you guys an awful lot there to digest, but this is just the basic stuff. If you don't get it now, what you want to do is go to your material. Depending on which training program you're in, some of you are in the flipping program, some of you are in the rental program, some of you are in the investor agent program, some of you are in the wholesaling program. This here is in all of those except for the flipping program. We're just talking about rentals right now, okay? But you all have it. If you're in the investor agent program, it's a module 2. So let me look for questions, and let's see how we're doing so far, and then we'll move on as long as we're okay. Okay, so hang on one second. Okay, Michael is asking, okay, so you do have capital improvements. Would it be calculated as part of the expenses? So Michael, good question. Now, first things first, I'm not an accountant or an attorney. However, I will tell you, when you make a major improvement, you would add that to the cost basis of the property. When it comes to tax preparation, you generally would not take that major outlay of money as an expense in that year. You would generally depreciate it over the lifespan of the property. So in other words, let's say we put on a $5,000 roof. Our original purchase price is $70,000. That was our original cost basis. If we decided to make that roof replacement part of the capital, part of the cost basis of the property, excuse me, this would now be $75,000, and we would depreciate that additional $5,000 over the lifespan of the basically 27.5 years. When you take depreciation, it's like 3.41% per year. That's how you would depreciate that roof, the roof installment. Now there is a tax rule. I think it's called Tax Rule 172, and this is where you want to check with your tax accountant. Okay, some tax accountants interpret that to mean that you can expense a capital improvement in the year that you took the hit and take it as an expense. That is true in certain businesses, and I'm not going to tell you that you should definitely do it with the real estate. I have done it myself personally. I will tell you, pull back the curtain here. I have taken capital improvements and expensed them in the year I took the hit. Okay, I've had many others where I simply added it to the cost basis and depreciated it over the ownership of the property. Now, to me, it's strategic. I'm going to do what's the strategically most advantageous to me, but you also want to check with your tax accountant, because some of them will say, well, they don't think that you can do that in real estate, and you'll have some that will say you can. So just check with your tax accountant. They'll tell you what they think you should do. But since, Michael, you brought up the question, the answer is it depends. Just like an attorney says, it depends. So it depends on your circumstances. You can, by default, you should generally capitalize every capital improvement and depreciate it, make that part of your cost basis. So that goes on the asset liability side of your balance sheet, not on the income expense side. Income, basic expenses, by the way, guys, are generally anything less than $250. That's your replacing a faucet, replacing a doorknob, painting, things like that, lawn care, snow removal, pest control. Okay, those are expenses. Capital improvements are generally bigger items, like buying appliances, putting on new siding, putting in a new roof, putting in all new flooring, for example. Not the cheap stuff, but if you were putting in hardwood flooring, that would be a big ticket item. Generally, you're going to capitalize those. You're going to add them to the cost basis and depreciate them along with the building itself. Okay, just basic rules of thumb there. So Michael, I hope that helps you out. There's plenty of examples that online, and I can give you some of my own too if you want. Okay, so Michael's asking what's a good cash on cash return rate. So Michael, it does depend on the region wherever you are. I mean, if you're up in Toronto, Vancouver, San Francisco, where I am right now, Washington D.C., Boston, Massachusetts, New York City, your cash on cash return, you'd be lucky to get 10%, but I would definitely shoot for 10% and no less, no matter what. So if you're in like, let's see, where are some of you most, New York, let's just take New York, okay? If you're in Manhattan, you may want to jump over the Hudson River and invest in New Jersey, okay? Um, or if you're in Washington, D.C., you might want to jump outside the Beltway and invest more in, like, out towards, let's see, uh, Upper Marlboro, someplace like that, or down near Fredericksburg, Virginia, or up towards Frederick, Maryland, things like that. Um, it just depends on where you are, but I would venture to say that you may need to branch outside the really high-priced areas a little bit to get a better cash-on-cash return. Like in Toronto, some of our students up there, one of them, in fact, just bought a property about 2 hours away in London, which was where I live, London, Ontario, part-time, because the properties are less expensive, it's easier to cash flow. Now, I want to mention something here. A lot of people have this limiting belief that, well, you can't invest in Toronto or San Francisco because it's too expensive. But that's not necessarily the case. Everything's relative. And wherever you have rentals, you have investments. Wherever you have renters, you have investments. Now, I can tell you, for example, here in San Francisco, people invest, and if they don't want to have a negative cash flow, they'll just put more money down on the property. They'll put, instead of 20% down, they'll put 50% down. I mean, they even pay all cash for properties. By the way, speaking of all cash, if you haven't noticed, guys, the cash buyer report is up and running on the silver level members area. So if you haven't used it, it's time to go ahead and see who the cash buyers are in your area. If you're way out like Bozeman, Montana, you're not going to have a lot of volume on that report. You might have to do the entire state to find cash buyers, depending on where you are. I mean, there's one of our students just ran it for, I think it was Wyoming, and I think TO had to branch out pretty widely to find some cash buyers there in Wyoming. It's just that it's just not as densely populated, okay? But in any case, what I'm getting at is you can invest anywhere and everywhere. It's just a strategy in an area like Toronto or San Francisco may be more a capital appreciation play. You're looking for appreciation, price increase versus cash flow. There's always a balancing act there, If you're investing in, Flint, Michigan, you're more than likely investing for cash flow, right? The average property there is about 70 grand, and you're probably not going to want to flip a $70,000 house. I mean, you can, but why not go down to different areas, like Commerce, Michigan, and flip a house there, right, for $200,000, right? So in any case, my rule of thumb is this: I always would give you my personal take on this, is 20% cash on cash. That's my personal rule. However, if I was in my 70s, I might be happy with a 10% cash on cash return. Okay, it's just everybody's different. So cap rate is going to vary the cap rate is something that you can't make a cap rate. In other words, you can't make a property have a certain cap rate at the initial time of purchase. You can improve a property and change the cap rate, or change a property and change the cap rate. But cap rate is something that you have to determine based on the area you're in. What is the prevailing cap rate? Okay, cash on cash return you generally have more influence over because you can put more cash down, less cash down. You can have more influence over the cash on cash return than you can on the cap rate. So, Michael, good questions, man, by the way. Okay, let's see what else we got here. Ryan Alley, hey Ryan, what would be a minimum cash return? Okay, I guess I was thinking ahead, so I just gave you the answer there. Ryan Alley, cash on cash return, yeah, depending on the area, could be anywhere from 10 to 20%. I know areas that honestly it's down to 5%, but everything's relative. It is what it is. You take what the market gives you and you go with it. Okay. Let's see. What do you mean by debt service? Stacy, yeah. So debt service is only the principal and interest portion of your mortgage payment. Okay. Let's see. Bill Morrow. Hey, Bill. All right. Bill is asking, okay, in your example, you have omitted both a capital reserve expense as monthly expense and management fee. Yeah. Real simple, Bill. I just wanted to provide a real basic, simple model. In the real world, like when you look at the next calculator that I'm going to show you, we absolutely do factor in things like property management. And for those of you who are interested, what he means by capital reserve expense account. So instead of you taking a hit every 10 years for a new furnace or roof or something like that, and basically handling it all at the same time, What Bill's getting at is what really good investors do is they account for that over a period of years. In other words, they sock away a percentage of income in a separate account that's accumulated, okay, to be used for those big capital improvements. And you can actually expense those. You can take those expenses during those years. That the money that you put into that account, you can call it expense account. And then when you do the capital improvement, you have to basically undo that and then take the capitalize it or put it against your cost basis. I'm not saying you have to. I shouldn't say that. What I'm saying is you likely will do that. You can't do both. Is what I'm getting at. You can't take the cost of something and depreciate it as a capital improvement and at the same time expense it. You have to do one or the other. So just I want to make sure everybody understands that. Thanks, Bill, for the question, by the way. Okay, let's see. This is from Dawn Ray. Hey, Dawn. Okay, Dawn is saying, okay, yes, currently in 2017, Internal Revenue Service IRC Section 179 allows a special bonus depreciation, which allows for full deduction in a year of purchase. New tax laws are being negotiated right now. Yeah, it's pretty awesome. By the way, guys, don't be afraid of what's coming down the pike here as far as this new tax reform package. If you've been around as long as I have, you remember the 1986 Tax Reform Act. Wherever something's being taken away, something else is being created. And I'll give you an example. Back in 1986, what was taken away was a lot of write-offs for people who were self-employed, what we call the S-types, as self-employed, like doctors, for example, who at the time were investing heavily in real estate because they got all these write-offs, and they would even make it look like they had a loss. They would actually buy properties with losses and take all the write-offs, right? Well, our Congress got rid of a lot of those loopholes, and what happened is all of a sudden these guys started selling all the properties. So guess what? That created an opportunity for guys like me who started investing on January 20th, 1986, when I bought my first property. So just bear in mind, always have a wide open view to see the opportunity. So quite frankly, I don't even care what's in this new tax package. I just want to know what's in it so I know how to react to it. Because I'm always, my thing is understand the rules and then you know how to play the game, right? Let's see, Dawn has another one here. Hang on one second. Okay, Dawn says, warning, with the new tax laws, this might go away. Yeah, that could be one of the things that goes away, so good point. By the way, they might take away the depreciation, the write-off for mortgage interest. And what does that do? It's people that say, oh, it's going to kill us, it's going to hurt us. It's going to create opportunity, right? Because people might decide to sell the property, right? If they can no longer take an interest expense and their property doesn't work for them, they might want to sell. Well, there's opportunity, okay? All right, let's see. This is from Bill. Okay. Right. How important should cap rate be to us when we're building our personal portfolios? I tend to focus on cash when cap rate is most relevant on a multi. Yeah. Hey, this is an excellent question, Bill. Both ratios are important. However, I will tell you, most investors who've been at it for a while, people who are really successful, they only look at cap rate initially just to determine what's happening in an area. They just want to see what's the prevailing cap rate. Because cap rate represents reward and risk, okay? Reward and risk. The higher the cap rate, higher the reward, but also the higher the risk, okay? They're just like that, just an initial barometer to say, okay, I'm going to look further. What they're really looking at is cash on cash return. So, Bill, you're spot on, man. Like for me personally, I'm way more interested in cash on cash return than I am cap rate, okay? So I would definitely lean more towards cash on cash return when it comes to the larger the property, the more important cash on cash return is, okay? Okay, let's see. What are you hearing about new tax laws and the effect they will have on us as real estate investors? Honestly, I don't watch the news, guys. What I do is, online there's all kinds of services you can get. You can just Google news service. I tend to lean towards something like C-SPAN, PBS, because if you turn on Fox and CNN and MSNBC and all those guys, they've got an agenda and they're trying to sway you one way or the other. And in fact, they're all bought and paid for by the advertisers, okay? And they want to convey a certain message. They want us to all take medicine. They want us to feel like we got a pill for everything, okay? And I don't like taking pills, so I don't. And I don't even. I'm so fed up with everybody bickering and them creating division in our country. I tell you, I'm not a political person, but I've been to all 48 low 48 states. I've been to 3 Canadian provinces. Canada, all 10 provinces are all liberal governments, and the federal government's a liberal government. But it's a wonderful place to live. In the U.S., the media has created this environment where the conservatives are saying the same things about the liberals that the liberals are saying about the conservatives. It's the most ironic thing I've ever seen. And yet, if you turn all that stuff off and you travel like I do, you realize, you know what? We all get along just fine. I'm not saying there's not exceptions. There's always exceptions to every rule. But there's 330 some odd million people in the U.S. on any given day. I forget the stats on this. Like 156 million people are going to work. 100 and some odd million devote time to charitable organizations. There's inter-religion marriages. There's interracial marriages. There's all these things going on that never ever get on the news. All they put on the news is one thing that happened in one town to 100 people. Okay. Once in a millennium, it's just, and then they make you think like the whole world's falling apart. In any case, enough of that. We all get along just fine, and I will tell you this: I don't watch the news. I select what I look at based on its neutrality, and also I'm only really more interested in business information and actual facts. I don't really care what the news people, what their opinion is of things. So if you want to look up, here's what I'm getting at. If you want to look up the the tax proposals, you can do that online and Google it and see what you find out there. I will tell you, one of the biggest is the possible elimination of the interest deduction. I don't know if it'll make it or not, but that's probably the biggest thing, Bill. Was that Bill that asked that question? Yeah, Bill. Okay, enough politics for tonight. Let's go to let's do this Excel spreadsheet, guys, because I want to use Ryan's example. All right. Let's first go to his examples. So here's a sample property. Thanks, Ryan Alley, for bringing this up. This is in Tacoma, Washington. Great area to invest in, by the way. It's outside of Seattle, and across the water is a great little town called Gig Harbor, man. I had a best time there. In any case, multi-unit. They're asking for 459 grand for this property. Okay, 460 grand to be exact. I'm assuming this is like an appraisal value for tax purposes. Okay, let's see if we get any data on this sample. Beautiful looking property, by the way. Looks pretty awesome. Okay, we got taxes. They're really not giving us a lot of information to give us here. Taxes. If they say it is a duplex, let's see if they give us any financial data here. Multi-unit, I'm not seeing any rents or any other income expense data, at least right off the bat. Oh, here we go. Rents, $1,700, $995, and something they're renting for $200, probably like a garage or storage or something like that. So we got some income, we got some expense. Now let's do this. Ryan also gave us, let me see if I can find it here, Ryan. Is this it here? Okay, opportunity evaluator. Ryan, let's go ahead and do that. Since we're looking at, let's go ahead and do this. So Ryan took these figures, guys, used rental property reporter. You can see the link up there. Actually, this is Ryan's link. If you go to here, this is all, by the way, all of this is in the silver level membership area down in the resource section where it says marketing material and other resources, okay? This is the actual link. You can do a screenshot if you want, but it's in your material and it's on the silver level area of My Investment Services. So let's go ahead and go back to Ryan's example. Okay, and let's see what figures he plugged in, and we'll see if we can break this property down and see if we can make it work. Okay, and if we have time, we will do the Excel spreadsheet too. This one's the more advanced one, but I'm going to do that first since it's what we have and it's what Ryan used. If we have time, we'll do it on the Excel spreadsheet too, which is called the rental property evaluator. Okay. All right, we're assuming a purchase price of $450,000, which is $10,000 off list price. Down payment of 20%, which is $90,000. And by the way, all these fields are variable, so you can just plug in your figures, right? So we're going to have a mortgage of $360,000 at 4.5%. Now, I can't click on the assumptions because this is a PDF that we're looking at here. So term, I'm assuming you used a 30-year term. All right, I'm not sure, but if you want to type that in, just let me know. In any case, monthly rent is, whoops, right, let me go back here, $28.95 per month. Cap rate is 7.72 currently. Now, we haven't done a lot of work yet on this, but so far cap rate is 7.72. We're assuming no improvements on the property. Okay. Sales price $547,494 with some assumptions. Again, the assumptions aren't expandable there. Land value 28% of the purchase price for a total of $126,000. This is important because when you calculate depreciation, guys, you don't do that on land. You only do it on the physical improvement to the property. Land is not depreciable. Okay. Property tax 1.25%. Okay, fair enough. That's probably reasonable. And now we get into there's different tables that are produced as a result of this calculator. Okay. And they give you a 5-year projection. All right. Now, right off the bat, we see our cash on cash return is 55%, which is pretty darn awesome. Okay. Now, I can't expand this, so let's see if Ryan expanded this for us. It looks like it is expanded. Okay, good. All right. So initially, we have initial down payment of $90,000. All right, and we have a loss in the first year, $7,000. All right. If you factor everything in, your rent minus your expenses, you got a negative cash flow, okay? And you got a negative cash flow all the way to the end. You see it decreases over time. But at the end of the 5 years, you actually sell the property, and you have a net gain. If you factor everything at that point, you've got $155,000 net gain. We'll talk about that later. And if you add up all of your net losses, okay, you got a total return of 49 grand, right? So you put in 90,000, you got 50,000 back. That's a return of 55,000 at the end of the day when you sell the property. Okay, 5 years. They're assuming a 5-year hold period, right? Now, whoop, I moved too fast. Sorry, guys. Let me go back up. Here we are. Now let's look at the tables. Okay, first things first. Initial down payment $90,000. We see our net losses over the years added up. So 90,000 down payment plus our net losses. All right, and then we have our sales price $547, and we selling costs are $32,850. So we're assuming we're selling the property at $547,494 after 5 years. In other words, we're selling it for about $100,000 more than what we paid for it. And roughly, that's a little bit less than a 20% gain, capital gain, just on the surface. Okay, so we got those figures. Now let's scroll down here. Let me just do the slow one here. Taxable gain. So a taxable gain of $123,000. What that is we took some depreciation, right? We had to add the depreciation back in. We had to do what's called recapturing the depreciation. So if you took a write-off of 3.41%, which is what most people do, over 5 years, you add that up through 3.41% of $450,000 is about probably $15,000 a year, right? Maybe a little bit more than that. Actually, it's probably 20 close to 25 a year if you had all. No, let's just keep it the way it is, right? And okay, so back to this. We got to pay off the mortgage too. That's $328,000 left on the mortgage. We got to pay that off. All right. We have our annual cash flows. The last year, the year of the sale, what they do here, which I don't really agree with, but they do it, is they add the gain on the sale into that cash flow for that year. Okay, that's why the number is so big in the year of the sale. That includes the net profits from the sale. I don't necessarily agree with that, but that's just what the calculator does. In any case, return on investment, or ROI. All right. Negative, 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 negative. At the end of the year, negative 18.6, okay? But there's more to the story, so let's keep going. So cash flows discounted by hurdle rate. Now, hurdle rate is it's one of those variables you can plug in up top. And I don't know if, Ryan, you kept it at 8%, which is what they give you as a default hurdle rate. Hurdle rate is a rate you're assigning to some arbitrary investment. If you invested it in this other investment, you would gain 8% on an annual return. What this is what do you have to do to beat that 8%? And you take your cash flows discounted by the hurdle rate, and that ends up being $2,000 in the positive, okay? So your walk-away price, in other words, you wouldn't sell this property if you couldn't sell it for any less than $452, all right? You sell it for $452 or more, you'd probably sell it. Otherwise, you'd keep it and keep renting it, right? Keep renting it out, okay? So let's just, it'll start to make more sense, guys, as I go on. Just if you feel like you're a little bit lost, don't worry. Practice makes perfect, and as we get through here, a lot of this stuff's going to start to make more sense, okay? So we have selling costs. You got to actually pay to sell the property, right? Got commissions and things like that. So your cash proceeds, sale price minus your selling costs is $514. You had a depreciated basis of $391, right? Because you depreciated the property. You have to regain that at the end of the day, $15,000. Well, I was pretty close, anyways. You have a taxable gain of $123,000, right? That's your proceeds from the sale minus your cost basis. That's your taxable gain, and you have to add recapture depreciation back into that. Okay, you got to pay off your note. Cash from the sale is 156 grand. So at the end of the day, you put in 90. You had some net losses throughout the years, and you gained 156 grand. That's just right now. We're not done yet. Let's look at the other tables. Obviously, you rented the place out. You had some rents coming in for the years, and we assumed a rent increase each year, something nominal. Maybe it was 5% or something like that. Okay, you had a total rental income of 173. You had rental expenses. Okay, at the end of the day, 78 grand on this example. Okay, you had taxes you had to pay. You had insurance you had to pay. You had what's called turnover cost on rental. So whenever somebody leaves a unit, it may be vacant for a month. You may have to clean, advertise, paint, things like that. That's just assuming you might spend around $2,000 per vacancy to get it back and occupied. It's just a variable. You can change that. Okay. All right. Maintenance. We figured annual maintenance is $4,500 a year. That might be a little bit high, but that's okay. Professional management. So Bill, back to your question, you can see now we're adding in things like management and some other figures, okay? In any case, total rental expense, right? You add all that up, and that's what you get. Net income, in other words, this was a property. Remember I said earlier, I know people who will buy with negative cash flow. Here's a perfect example. This was basically a negative cash flow property, but because of the capital gain, it might end up being a pretty good investment. We're going to see here at the end. Okay. So in any case, we had depreciation. You add all that up over the years. That's your total depreciation. 11,782 times 5 is 58 grand. So you now have a taxable income of minus 59,000. Now this is just only on the income expense side. We're going to get to the rest of it later. So hang on to your hats here. All right. Tax benefit / cost 14,000. And principal reduction 31 grand. So in other words, when you were paying your mortgage payments, you reduced your principal by 31 grand. So your net cash flow was a minus 16 grand. I know some of you guys are thinking, why the heck would somebody buy that? Well, just hang on. Well, we didn't get the rest of the tables here. Okay, so let's do this. I'm going to go to now a live version of this. Let's plug that in. Let's go over here. Excuse me. So 450 grand purchase price, down payment 20%, 90,000 down payment. Interest rate, let's say interest rate is 4%. Now let's look at assumptions. I'm going to go ahead and get a little more creative here. I'm going to assume let's keep the term 360, buying cost 1%, that's okay. All right, monthly rent, I think it was somewhere around 3,000. Oops, all right, let's just put in a cap rate. That's what it is right now. So right, I'm going to just plug in, I'm going to do this on the fly. So I may or may not use your fingers. I just want to get through this and we can change things. Vacancy rate, way too high. It's probably going to be more like 2% right now. Rent increase, let's keep that at 4%. There's some areas, guys, where, like in parts of New York, Brooklyn, Queens, rent increases have gone through the roof, you know. Okay, property improvements, we'll keep that the same, nothing there. Property management, I'm going to say that's, let's make that 8%. Maintenance 1%. Insurance costs, let's keep that. Move in, move out costs, let's make that 1,000. Okay, let's go down here to sales price. Assumptions, selling commission 6%, annual appreciation 4%. Let's keep those the same. Okay, land value, let's make that 5%. Property tax, let's make that 1%. Okay. now let's look at some figures and see what we have here. Okay. I'll probably change things up a little bit, and that's okay. First things first. I'm not going to go over a lot of detail because we just went over this. I just want to get to the lower table so give you the final picture here. You can see at the end of the day, your final net cash flow was 82 grand when you factor in all the income and expenses, including the sale, the eventual sale, and the gain on that sale. This is what you walk away with. So you put in 90 grand and you're putting 82 in your pocket at the end of the day. I think that's what that was. Wait a second. Yeah. So let's go forward here. Return on investment, you can see at the end of the day is 20%. Present value, this is your cash flows discounted again by the hurdle rate, 26 grand. Walkaway price, you wouldn't sell it for anything less than 476. Okay, so we definitely change the numbers here. If we can sell it for 547, it tells us we should sell it. Right? So let's see what happens. We've got selling costs. All right, we already talked about depreciation. Cash from the sale is just about the same, 154. 321 is not that much different. Let's pull this table up. Financial projections. These are income and expenses. Okay. At the end of the day, net cash flows about 18,000. I think that's better than before. All right. And again, here you've got this is just like you would see, guys, on a Schedule E of your federal tax return. Okay. This is exactly what you would see. You wouldn't see all 5 years. You would see the current year. Okay. Interest, taxes, insurance, turnover rate, maintenance, all that's in there. Okay. Here's your depreciation again. There you go. Taxable income, principal reduction, and there you go. At the end of the day, you got 17, almost 18,000 net cash flow. Right. Here's your. This is where things start to get interesting. Okay. We know we put down $90,000. Yearly price appreciation is about 18 grand. That's what it looks like. 18, 19, 20, 21 grand. Appreciation net of taxes, in other words, once you figure out you got to pay taxes unless you got to account for that, a little bit less. Okay, so you have a net cash flow here that is negative in the beginning, but it goes up over time. Right? Net worth increase. This is your net worth, just the increase over the 5-year period. Okay, and this is your return on investment. Net worth, which is your net worth gain on net worth divided by your initial investment. In this case, 90,000 bucks. Okay. Now, let's see what happens here at the tail end of this deal. This is just your mortgage information, by the way. All right. So loan balance ended up being 360 after you paid it all off. These are the numbers on your interest, principal reduction, and the total mortgage payment. Okay. Now back to this. Would you guys do an investment for ROI of 26%? Well, I probably would, right? No doubt about it. We did make some changes. We got a better figure on cash flow here. All right. We do have a cash proceeds from the sale, right? We put 90 in, got 154 back at the end of the day. All right. So at the end of the day, Ryan, if these are reasonable figures, in that area, this is more of a capital appreciation play, not a cash flow play. This is a unless that guy puts on a lot more money, this is not going to be an investment necessarily for cash flow. It's going to be an investment for capital gains, for basically, uh, you put money. It's like buying a stock. You buy a stock for $10. If it goes to $20, you cash out and you just made 100% on your money. This is assuming you're going to have continued price increases in your area, and I've obviously been there, and I think that's probably a reasonable assumption because that's what you've been seeing for quite a while. Now, we do know that there is a shift. We're technically in it. We don't know anything more about it, though. Nobody knows when, how big, how deep, how long, how wide, how anything. We do know that recessions tend to affect different areas differently. So the last time around, if you're in the U.S., there were parts of the country that were not really affected that much by the recession. Okay, most of Pennsylvania was one of those areas. But if you were in Florida, Southern California, Phoenix, Vegas, they were crushed. You know, um, but there was parts of the country that were like, hey, it was just another dip in the economy. That's all it was. In any case, what I want to do, guys, is this. We got about 10 more minutes. Let me check for questions, and if we have time, we'll do the Excel spreadsheet. If we don't, we'll do that next. No, we won't do it next week because next week we got a special guest. Let me talk about that here in a minute. Okay, let's go to questions. This is Ryan. Welcome. Oh, thanks, Ryan. Okay. Original list price. Yep, that's what that was. Oh, okay. So Ryan says, I think I did 20-year, don't quite remember. Yeah, by the way, guys, what Ryan's talking about is the right over here, your term. I generally prefer a 20-year term when I'm investing. When I'm borrowing money, I prefer a 20-year term, okay? A lot of investors, if they can get a 30-year term in the beginning, they'll do it because they'll be able to get an FHA loan for a couple properties. But those are quite difficult. They're just a pain in the neck to work with. And there's a lot to be said for paying off the mortgage earlier and increasing your equity position much faster, okay? For the example here, I just kept it at 30 years. Okay, this is Fassel. Fassel's asking, hey Fassel, just curious, why would someone want a negative cash flow for 4 years? How can this deal become positive cash flow? Excellent question, Fassel. So it depends on where you are, Fassel. In certain parts of the country, believe it or not, there are a lot of investors who will purchase with negative cash flow. Now, you can, if they're savvy enough and they have the capital, they can avoid negative cash flow by putting more money down on a property. I mean, there are a lot of investors who actually just use all cash, and dollar for dollar, they never have a negative cash flow because they've always got rents coming in. Some investors will borrow only what they need to borrow, so that they have at least a net zero. They're not losing money on a monthly basis. They're not getting money on a monthly basis as far as income goes. They're more interested in capital appreciation, which is what we talked about. So the answer, Fassel, is they're willing to invest in a property knowing that down the road they can sell it for a big gain. And if they bought a house for $450 and sold it for $550, $100,000 is not a bad gain on $450. But more importantly, if you factor in that they only put down $90,000, okay, and yes, they had negative cash flow for a couple of years, so maybe their down payment plus negative cash flow was $120,000, and they sold up for $100,000 more than they bought it for. You're still way ahead of the game, Even in this example, even though we factored in other expenses, they still put $150,000 in their pocket when they sold it, and yet when they bought it, they only put $90,000 down, and negative cash flow was not that great. In fact, let's just go back and look at what the negative cash flow was. Come on, computer. Okay, let's see. Yeah, it was, obviously, it actually wasn't negative in this example all the way through. Let's see, let's bring up Ryan's example. Let's go back here. Okay, so hang on to your seats. Here it is. So you can see the negative cash flow FASO over all those years only amounted to $16,000, right? So if you add 16 to 90, this person had out of pocket on a cash basis $106,000, and yet they put in 154 in their pocket at the time of the sale when you factor in all the other factors, right? 156 grand to be exact, okay? That's not a bad day at the office. So that's why FASO people, not everybody is investing for cash flow. There's multiple reasons to invest, multiple objectives, multiple motives. So this would work for a lot of people, Okay, let's see. Ryan says, I left all the default numbers in. I think it was 4% increase. Yeah. So Ryan, what I would do is, so when you go back through this, just kind of get a rough idea of what are some of those ratios in your area and put numbers in that are commensurate with your area, okay? Let's see, our Bill's asking, okay, with the data from the example, is this a property that would hold for long-term or turn it over in 5-year period in the example? Well, I don't know the particular investor's motives, Bill, but usually people, if they're doing what's called a capital appreciation play, in other words, they're not really looking for cash flow, they're looking for capital gains. They usually have certain benchmarks in place. It's usually a combination of time and increase in value. So they'll say, okay, I want to hold this property for minimum 10 years, or minimum 5 years, maximum 10 years. And anywhere in that 5 to 10 years, if I've achieved a certain capital gain, in other words, in this example, what was it, 55%? Let's go back and see what that was. I think it was 55%. It was that cash on cash figure. There it is, 55%. That's what I'm saying is that may be their game, that may be their criteria. Somebody else might say, I want to hold it for no more than 10 years period and no less than 10 years. In fact, 10 years I'm going to sell it regardless. Yeah, some people might say they'll hold it. They don't care about the time frame. What they care about is what the property goes to in terms of increased value. So if they bought it for 100, they might say, I'm going to hold it till it goes to 200 no matter what. In most cases, Bill, people are using a combination of time and increase in value. It's a combination of those two factors. That's usually what you'll see. And everybody's different. That's why you really do have to interview your investors and find out what their motivation is and what's important to them. They'll tell you. So in any case, guys, we're probably too close to start something new. So I'm going to hold off on that Excel spreadsheet, which is actually easy. If you all have it available to you on the silver level of the membership section, just go to myinvestmentservices.com. First, click on the members area. It takes you to another screen where you have to log into silver. So log into silver. Then down on the left-hand side, you look for I think it says marketing tools and other resources for finding information on people and properties. The Excel spreadsheet, what we call the Rental Property Evaluator, is in there. So you can just play with it. Just download it, and it's interactive. You can plug in your numbers and change them all around. It's a snapshot calculator. So this right here is more of a projection calculator. The one we use tonight, the one that's in the Excel spreadsheet, is a snapshot. You change it, it's just that point in time. It's not doing projections like this is. Two different scenarios altogether. This one would appeal to financial planners and things like that. The other one would appeal to people like engineers, things like that. I mean, engineers will like all this stuff, to be honest with you. So in any case, I hope that you guys enjoyed that tonight. I know this looks like, I know when I first saw this, guys, it was a little bit intimidating. But the more I played with it, the more comfortable I became. And you can click on all these things and find out what they say, right? You can click on all these things and find out what all they mean. All the information buttons, just click on them, okay? That's the best way you're going to learn, and play with it, change the numbers around. And the more you do, the more comfortable you become. because at some point, what's really cool is you're going to show this to your investors. They're going to love you for it. Okay, so in any case, one more thing, guys. Next week, I do want to put in a plug for a guy named Steven. He's coming on board to our weekly webinar next week. Steven is a private lender in New York, and they lend, I believe, in all 48 of the low 48 states. I don't know if he lends in Canada. We can ask him that next week. But it's private money, so it's not hard money, and it's also, I mean, it can be, but it's not necessarily, but it's not traditional bank money. And what he's going to do is help you guys figure out how you and your clients, if you're an investor agent, or yourself if you're an investor, how you can qualify and influence a private lender to work with you. Okay. More importantly, he represents a big company that does this. So Billy Maloney, all you guys out there that have been chomping at the bit to really get that next deal. I know it's hard to be patient sometimes, and it is for everybody, including me. This may be an avenue for you to pursue. Okay. So be on board next week, guys. It's going to be pretty awesome. And, Steven's going to share with you his contact information too, so you can refer your clients to him, or you yourselves can use him for some private money. So Faisal, this may help you too, up in your area. And Ryan, also, if you have, going forward, if you have specific questions, Ryan, let's just do another call and see how that looks, all right? So, in any case, you guys have a wonderful night and awesome rest of the week, and we will see you next week. God bless you and your families. Okay, bye-bye.